What's up, investors? Hope you're having a good summer. This is the quarter three preview for 2024. Some of the quick things to start off. I think we're all waiting and holding our breath to the latest round of interest rate cuts. Right now, everybody's predicting September 2024 for those to happen. We've been starting to see the cracks in the economy, which is a good thing, right? Because it gives the Fed the data to finally start dropping rates, which at that point will bring back the cap rates and inflate the prices of real estate and other investments out there. But the one thing that's holding things up this year is obviously the election. The Fed does not really want to pick sides, Democrats or Republicans. So that's what's causing a lot of this delay. And what I suspect is, as most things played out, as I've seen over the years, things just tend to drag along. But before we get moving off into that history lesson, a little bit of recent news over this last quarter. We hit full occupancy on our development out there in Huntsville, Alabama, the views at Chase Creek. Right now, for those investors, just a matter of waiting till interest rates come back down and the cap rates come back, and we'll be able to sell that thing, or maybe we'll hold on it for long term. Great situation out there. And our other development, also in Huntsville, the 300 unit Manor at County Line. We've got 100% certificate of occupancies on all the buildings out there, and we're starting to lease up. Right now, we're about 20%. So hopefully, first half of next year, we should be able to be 100% leased up on that one. We sold a 170 unit out there in Huntsville, Brookridge, and returned about $5 million of distributions back to investors on that one. This property purchased back in 2020 had a great basis on it. We picked up that asset for about 8 million and sold it for about 13.5 million. The business plan on that one was your vanilla value add, cosmetic value add, including pairing a lot of the exteriors, repainting, parking lot repairs, and all the interior upgrades on that one to bump the rents up. And obviously focusing on the management and improving delinquency collections. So investors are pretty happy about that, despite the difficult market, which we're going to be getting into here. Overall, across the country, properties went down maybe about 20% to 30%. So being able to be a part of a great exit like that was a big thing in this kind of a difficult time. But difficult times make for strong investors and great investments, right? Right now is the time, prior to interest rates coming down, is the no-brainer time to enter the market, if only for just the mere fact that the basis is what you're picking up the properties for are often 20% to 30% less of what it was just a couple of years ago. There was a question that somebody submitted, oh, what's good now? These days, right now, there's a lot of extra supply hitting the market in a lot of markets, because prior to 2023, when the interest rates started to go up, everybody and their mother was taking advantage of this free money. So everybody built stuff. So like how people are born in 9 months, developments are born in 2 to 3 years. So a lot of that tail end of that wave is hitting right now, which is nice for people in the market because that's going to go away after next year. And there's going to be a big lull right there. But right now, your new stuff, which is your Class A stuff, is being added on the market. And the losers are this value add and this lower end stuff, the Class B and C stuff. Imagine like your new stuff goes on the market at $2,500 per month, right? Your slightly older stuff that would have gone for $1,800 to $2,200 a month rent, it's being competed because put yourself in the shoes of a young millennial. I'm just going to go for the really pretty stuff that has like a bar in the lobby for $2,500. I'm just going to stretch and go from 2,200 and pay a little bit more because I'm really bad with my money anyway, and that's what young people do. Right now, you're having a crunch on that more value stuff temporarily. There's this train slack effect. So right now, if we're going to do value add projects, it's going to be more of this core plus stuff. So this is going to be like stronger areas, less tertiary markets. So stronger areas are like the big secondary markets. We don't invest in California, Hawaii for obvious reasons, but like your Dallases, your bigger metropolitan areas, less tertiary markets like those, like Wichita Falls and those types of markets. And then also that also means your nicer stuff. So Class A, but built 2020. So not brand spanking new, but not 1980s Class B. So that's just
maybe that'll be the trend for the next few years. And then it'll change, I'm sure, as things change all the time.
We're going to be focusing in on class A minus assets, the 2020 vintage, right? And as opposed to the 1960s, the 1980 types of properties. So more nicer class B assets, or what people call core plus out there in stronger markets. It just makes sense that right now the class B and the C assets are getting hit a little bit harder than some of those nicer assets, the class A. Obviously, we've been working on an acquisition lately of a 2020 build, great asset, great market, and a great timing within this market cycle post correction within commercial real estate. As far as rent growth, I think we can say that 2023 was a bit of a stagnant year. Of course, this is national statistics, but I think it tells the story of a lot of the markets that we're in. You're seeing a lot of, obviously, rents skyrocketed post pandemic 21, 22, and then things came way, way down. Almost in some markets, there was actually a negative attraction, especially markets like Atlanta and Austin really got hit hard. We also saw a lot of stagnant rents in Phoenix. But I would say as of the end of quarter two, definitely started to see an uptick in the market. And what I call this is getting back to equilibrium of 2 to 3%. Again, going over the interest rates again, because interest rates really drive the asset prices at the end of the day. You're seeing there in the black line what happened from a high level with interest rates as they started to come back up. This is again why we haven't picked up any major assets since July of 2022 when interest rates really started to pick up. And right now, you're starting to see the prices come back down as of the July of 2023 to, I would say, first quarter 2024, you finally started to see the prices stabilize. Of course, this is not depicted on this graph. What's on here is the CPI. So the Fed has been increasing interest rates to cool off inflation. There's a lot of different ways that the Fed measures CPI. There's a lot of controversy out there, which is the best one, but overall, all of them are coming back down to a point. And as we're seeing, the last new job creations recently came out at 150,000 new jobs, which is slightly below 250,000, 300,000 jobs is what the Fed likes to see created on a monthly basis. So someone say that's obviously bad economic news, but as far as we're concerned, we want that data to really give the Fed the evidence to be able to finally cut down rates because it's been this high for so long, over a year at this point. And here's some updated numbers in terms of the sales transaction volume fell off a cliff. You can see that peak there in 2021. We're probably about a fifth or 20% of the transaction in the heyday in 2021 and the beginning of 22. The reason being, again, you think of the market in terms of buyers and sellers, and the buyers left the market because with high interest rates, people can afford less, just like residential real estate. And this is exactly why we as buyers pulled out of the market and stopped buying June, July of 2022, and only now getting back into the swing of things because this blue line right here, the pricing has finally come back to a equilibrium point to catch up to where the interest rates are pricing at. And as you can see here, this is coming from CoStar. They're obviously forecasting this big push up later on this year into next and beyond. So this is exactly why we tell investors the Fed has already signaled what they are going to do. And when interest rates come back down, the sales volume goes up and then the market gets hot. And then now you get into a seller's market at that point and prices start to go back up. And I would also argue that the Fed, they're in a losing battle overall. They did so much to damage the economy just to slowly bring down interest rates. What's going to happen when they just bring interest rates back down? Inflation is going to come back like crazy. And this is exactly where you want to be an investor. You want to have your money in assets that float up with inflation. Another thing to keep in mind, we had on the podcast an economist that mentioned that the inflation data is 12 to 18 months delayed. So right now, if inflation is about 3 to 4%, that is actually 12 to 18 months delayed because majority or about a third of the inflation, the CPI data is made up of residential rents. So we know that 18 months, 12 months ago, that rents were stagnant. Some markets even went down a little bit, but that has not been input into the inflation data yet, because again, there's at least a year lag there. So we can expect to know that the CPI will continue to come back down, giving the Fed even more evidence to keep dropping rates over the coming year. Some will say that this will even push inflation closer to that 2% mark. And just to reiterate, like the correction in commercial real estate, you're having assets that one time in 2021 were priced at $30 million and now in the low 20s. It's just phenomenal, right? You're saving at least $5 to $8 million right there in that particular asset. And that's why we say now is the time. And a little bit of quick highlights of what happened in the market. So the big guys are starting to come back. The institutional money that has been waiting on the sidelines for so long. KKR buying $2 billion apartments from Lenmar, Blackstone getting involved now, and higher quality apartments are now at a 5.5 cap rates, which is signaling, man, like you're getting these things at great prices right now. We now know that prices peaked during that 2020, 2021 COVID rebound, and we've had this 20-30% corrections. And I think there's a bad narrative going out there. Like people say that there's a lot of pain coming for commercial real estate here in the future. I would probably argue that definitely is coming for office space, because office space has definitely changed the work from home dynamic. But as far as residential real estate apartment, people need a place to live, population is growing. The long-term fundamentals for residential apartments is very positive in the future. Now, there's a lot of supply hitting on the market that's going to burn off next year, as a lot of new construction projects entered into construction from 2020 to 2023. So about 2016, you're going to see that start to shut off. And that's going to bring back equilibrium back to all apartments with not a lot of new supply coming online, which is exactly why we want to start building now so we can come online in 2027, 2028. But there's a binary effect here. Yes, the market is going to be really bad if you were an unfortunate investor who bought an asset at the peak. You bought in 2021 and 2022. You may be still alive right now holding on, but your death is going to come. You just bought at too of a high price. Everything's in hindsight. But right now, on the other side of the coin, it's very good for new buyers, which is why we want to be entering in assets that make sense with long-term debt financing that we put in place. When you hear the headlines about deals going into foreclosures, ask yourself, when did those assets get picked up? What kind of debt were they in under 2 to 3 years loans? Because yeah, if you bought it at the peak, you bought it for 20, 30% higher than what they are today, and your loan is coming due, you're screwed. Completely separate that from going into new deals where the basis has been refreshed, or you're getting things at 20 to 30% less than what it was a few years ago. And we're starting to see a little bit of the activity for sales go a little bit up. We're obviously going to be watching this over the next quarter, especially as we start to see this confirmation of the interest rate peak, which again, everybody's calling it for September. And what I would tell a lot of people is this is very reminiscent of 2010 and 2012. Remember where you were at that time. Perhaps you are still in college or you didn't have money to invest. Maybe you were starting to get into investing at that point. We may not see another opportunity like this in your lifetime. But here we get into the report.
Background. What has transpired? The pandemic came in 2020. Inflation hit a 40-year high. Inflation came, almost hit 10%. And the Fed came in and increased interest rates to a 40-year high. And more importantly, a quickest increase in history ever. So you can see this on this chart where you're seeing in the yellow there is the 2022 rate hike, where things went to, and then it went off the charts to 5.5%. And you can see it in comparison with the other past rate increase cycles. Here's the inflation numbers. As you can see in 22 there, we hit that high. And that's what brought about these interest rate hikes the summer of 2022, because that's when we stopped buying these value add multifamily projects. That was our last purchase. So it's been quite a while. As you can see, inflation has come way, way down to 3.2%. It is still considered a little bit sticky. Fed wants to get it down into the 2% range. I would say a big part of this statistic is misleading because a big part of it is what are the rents doing? What is housing doing? And as we all know here, rents are based off of annual leases. So it is a huge lag. A lease is 6 months, probably more of a 12-month lag in here. And as we all know, and what I'll show later on in the slides, is as of 6 months a year ago, rents have been pretty much stagnant. It's starting to come back right now. But what I'm saying is 6 months a year ago, the rents are pretty stagnant. And that's what we're going to start to see coming out in the CPI numbers, because again, the CPI takes pretty outdated information in. And we already know now, 6 months ago, what the rent increases and how that will affect inflation down the road. From that, you can theorize that currently today, inflation is a lot lower than this number here. That is previewing interest rate cuts in the future. Of course, inflation doesn't hit all places. One of the biggest insurance goes up and down, and right now we're at a peak. And I do think it's somewhat mutually exclusive. When you get high inflation, it increases all rates there. You're just having these two things coincide. So in this chart, you see the core PCE inflation data and how that started to chip up. And just for more background, the reason why it went up is because there was like so much money pumped into the system to keep America afloat when we shut down for some months there during the pandemic. And just you can check past quarterly reports, but the amount of money that was pumped into the system, fake money, was way, way more than was pumped into. Conspiracy theorists say out there that there was some other issue, that the pandemic was just a great excuse to pump a lot of money into the system to prop things up. But of course, those are just conspiracy theories. And either way, who cares? This is the state that we're in right now, which is high inflation. Inflation kind of trickled down. This is the Fed's pretty much only lever for them to pull. And their primary focus is to moderate the economy so it doesn't get too hot and so it doesn't go too cold. Their bigger fear is that the economy gets too cold, meaning that they don't want to damage the economy too much by increasing rates so that we go into depression mode. It's one or the other. It's a difficult thing. I think the Fed actually does an okay job doing this difficult task. I do think that they have everybody's interests in mind. I'm all for modulating the ups and downs of the economy. That allows folks like us to predict things a lot better and do what we need to do. But yeah, just mind you that they would rather have high inflation than go into depression. And they're going to always, from a high level, they're always going to be increasing, decreasing rates to modulate this. And right now we're in a high interest rate period. And at some point, we're going to be going more downwards. Now, this sentiment has changed, and you've seen this change slowly. The talk is no longer, at what point are the interest rates going to hit? We know that with high confidence that the rates are at its highs. But the question has now changed to, at what point will the rates come down and at what pace? So everybody's got different theories. You see different predictions out there and different predictions for other banks around the world. Of course, that can always change. And we've been in this state of pausing for, I think, the last 2 or 3 quarters here. If you've watched my quarterly reports, I'm going to say sorry that it's going to feel a little bit of Groundhog Day to you over the last 2 reports. A lot of this is impacted by interest rates, and we've been stuck here. I'm sorry if you're saying that Lane is not original with his content, but that's just really the state of the economy right now. But it does look like, if you base it off other interest rate cycle hikes, that it is looking like a textbook increase in rates, and we should start to see things coming back down. Of course, our best indicator is what's happened in history. Here are some of the big banks out there, what their predictions are. What I would recommend is that you can Google the Chatham Financial Curve or I'm lost for the name, but I'll put it in my newsletter. But you've seen here in comparison to the other decreases throughout the years, the 2018 cycle, the 1995 cycle, how did they look? Because that is going to be our indication here. And if any indication, these things typically go down a lot slower than they went up. But if all this is reviewed to you, now's the time to wake up. Here's the new things recap in 2024 quarter one. This is sort of the demand of multifamily out there. And in 23, listings and sales or transaction value, they plummeted, right? Because the cap rates increased, which means that your prices come down. And there's a divide between buyers still think that the properties are worth 30% more than what it is. And sellers think that I can't really get good financing at this point. Why? Because the interest rates are high and I got to put so much down payment into getting an asset. And that was primarily the reason why we haven't really bought anything since 2020 summertime. Because as a buyer myself, I would have to put so much money down that it would skew my return metrics to a point where my returns would just go a little bit lower. And I just didn't want to pull the trigger. And as you guys all know, values across the nation fell 20 to 35%. Certain markets like Atlanta came down, Phoenix came down, maybe a little bit more than that. Now we now know that quarter one, 2022 was the peak in the market cycle. You never know when that's going to be. This is a kind of a good sign in the market right now. Apartment demand more than doubled. And absorption, what absorption is when new units come online, are people moving into them and are they being absorbed? So that's where that term comes from. It surged from 49,000 to 103,000 units. And this exceeds typical pre-pandemic first quarter demand, which normal is about 50 units there. So you can see that depicted in the dark blue line here. This consistent positive demand for 5 quarters, and the annual absorption reached 300,000 units. So this is, I think we're turning the corner in terms of we're going to start to see the rents come back up because this huge wave of supply starting to dwindle down, because we know what's happening 2 to 3 years for in the future with supply. They just weren't building at that point. And fits into my guesstimate in the future that inflation is going to come back like a mother and it's just going to be off to the races again, which means if you buy assets, you're going to be rewarded. Inflation is essentially a tax on the lower middle class and lower class out there. If you're not one who buys assets and you just sit around, the wealthy buy assets, you will get screwed with inflation. If you've heard the term gambling, all the political things aside of gambling, but essentially at the end of the day, what gambling does, it's a tax on the poor because most of the poor people they gamble, lottery tickets, scratch tickets. It's sad, but that's the unfortunate result of that type of stuff. Now, I follow ITR economics a lot, and they've already shown that the housing market and the financial market is leading everybody and has already gone to that trough and starting to come back out of that trough. And to me, that's a buying signal number one here. You're already seeing that these top markets are facing supply deceleration, which is good, right? Which is good for rents in those areas, because when the supply deceleration hits equilibrium, that's when you're going to start to see those rents come back up. Just some markets on here that I think a lot of us are accustomed to seeing. And this is the big slide here for those you guys who are currently investing over the past several years. You feel this at your core. For those you guys who came over the last year, you might be totally oblivious to this. So I graduated college in 2007. So I knew what it felt like to be working and potentially be cut as an employee when the 2009 fallout all happened. Now, there were some lucky souls that graduated college in 2011 and 2012. In a way, if you're a new investor today, you're like one of those lucky guys because in commercial real estate, the 2023 downward turn is worse than the Great Recession of 2008. Now, this may clash in your head, but one of the reasons, if we all look back in 2008, I think all of us saw the Big Short movie. The problem there was in residential real estate where you had a bunch of stupid loans given out to individuals. In this case, you had I don't want to say stupid loans, just nobody really predicted. And when I'm talking about nobody, the institutions out there didn't predict that the interest rates would go up so quickly. Again, quickest time in history to hit a 40-year high. And that's what created a lot of bad situations to have the market to come down 35% off the prior peak. And this is investing 101 in real estate. Number one, you purchase during high interest periods and refinance or offload when rates fall. Duh, that's right now. And remember the eight financial downturn, people saw their 401ks and property values decrease 30, 40%, and even 50% in mere months. And for those you guys who are in your 40s or 50s, and we go back to what it felt like in 2005, 2006, and then forget about 2008, 2009. That was a lot of pain and anguish. But remember what it felt like 2 years later in 2009 and 2000. Were you even watching the news? Were you even on a webinar like this? What did it feel like? Or were you totally oblivious and did you finally get into real estate in 2018, 2021, or worse, 2022? I say that because I started investing in 2009 and I saw this all kind of happen before my eyes. For most people out there, you're only going to get one opportunity like this to jump in when the wave is going to start to happen. And you're only going to make a lot of money in the beginning. And that wave is right now. We're seeing this happen in the market today, and we'll talk about another big player that's jumping into the market. Do you feel regret back in 2010, 2012 that you didn't jump in? I've talked to a lot of investors. Not many people who were in that got hurt. Maybe they were flipping houses in 2007, 2008 and got caught. Unfortunately, with some of those guys, when I talked to their stories, they got taken out of the game. They weren't able to get financing and they sat out and weren't able to come back into the game until 2015 and 16, which they lost out on maybe about 2/3 of the greatest time there. Again, history repeats itself. Market cycles are typically 7 to 9 years. This last one was an extremely long one. To answer the question, how did these properties fall in value so much? So commercial assets and pretty much all businesses out there are based off of net operating income, which is the income minus expenses divided by the prevailing cap rate out there, what the assets are trading for. And that's what the magic formula that equals the market price out there. So what you see before 2021, 2022 at the peaks there, if you had a property that was performing at $4 million net operating income and the cap rate was a 4 cap or 4%, you do this little magic formula here and you come out with a market value of $100 million. But what happened after, as the cap rates adjusted to say a 6 cap, same property, $4 million, and now it's worth $67 million. And that, my friends, is what essentially happened. Nothing to do with the operation of properties. Just unfortunately, when you change that denominator, that's how you get a change in prices. So for people who are new to the game here, looking to jump in, you should be salivating at the mouth right now, because in theory, we're at this inflection point. We should start to see these cap rates start to readjust back to normal. Maybe not get down to 4% right away, but from a 6 to a 5.5 cap, that's a lot of money of market appreciation there. And you may feel queasy, uncertain, but that's what Uncle Warren Buffett says. When there's fear in the streets, that is when you need to invest. Now, here's the problem, right? With some value add projects, Even if you were able to execute 100% of the business plan and bump the net operating income from $4 million to $4.8 million, you're still at a market price of $80 million. So there might even be some great operationally and value added assets out there that might be still 20 cents at a discount. This is the most important thing ever. This is called the reversion cap rate. I call this cap rate gate. It's one little cell on the spreadsheet, but if you really wanted to fudge your numbers, you just change this one cell on the spreadsheet. And what this is, it's basically saying like, all right, we think that we're going to sell this deal 3 years, 5 years from now in this type of market, right? This is what the reversion cap rate will be, or the exit cap rate will be at the time and when we sell. The thing is, nobody knows what the reversion cap rate will be come, what is it, 2029, right? A good rule of thumb is to increase the reversion cap rate to assume that you're selling it into a softer market. Counterintuitive, but on the next slide, when we play around with the numbers, you'll see. But the property value is the net operating income divided by the cap rate. If the market gets softer, it might trade lower at a 6.5 cap as opposed to a 6.25 cap. As this meme says, if you're buying something at a 4% cap rate and the market corrects at a 5%, you're screwed if you didn't account for it in your underwriting. More times than not, and this is just part of the game, folks. You have to understand this. It's like you go to a car lot, used car lot especially, and the guy's like, all right, it's $15,000. And you just laugh because there's room for negotiation. Just like an operator puts out a deal at 95% return in 5 years. All right, what numbers did you kind of mess around to get to that number? And this is again the biggest one here. But here's an example, and you can see how much it fudges the numbers. Say today we bought this asset at a 5.25 prevailing cap rate. And this has nothing to do with what the asset is running at. That's a totally different topic that confuses a lot of people. That's also called the cap rate of the asset. This is just the prevailing cap rate of the asset and what they're selling at. So say you bought something at a 5.25, the market corrects and it's 6.25 tomorrow. If you assume that if you were a good Boy Scout, which nobody does this these days, and assume that the cap rate increased 6.25 and your return was 100% return in 5 years. But if you would assume you only were a little bit conservative and it was 0.25%, then your projected return that you showed investors was 144. But then you were screwed because you didn't account for that. So this probably reversed the other way. I think I'm kind of explaining this a little bit confusing, but basically you see the spread in the numbers, like 40 something percent by underwriting it one way versus the other. And this is why what's on that PDF, it means nothing at the end of the day. This is where we try and teach investors like, hey, these are some basic stuff to spot check so you don't get hit by this bus right here. This is sensitivity analysis. So you can see if the exit cap rates here change, you can see how these numbers really start to change here. Again, if you use a really aggressive reversion cap rate, like the projections can move 40% one way or the other, is the takeaway. Some typical lending terms. Now, there's a little red there because there's definitely blood in the streets on this, and that's the important part. But here, the crossed out portion is if when I gave this presentation 3-4 years ago, what people were getting. The new one is today, so a little bit higher interest rates. The big one is the loan to values are a lot lower. And this is why I think you're not getting as many deals done today. This is why we stopped. Our last transaction was June of 2022. We haven't been very active because I can't make deals work when I have to bring 20% more to the table because the loan to values that banks are given is a lot lower. But the other thing to look at as an investor, if none of this makes any sense to you, is just to be aware of the term length. So this is different from the amortization. Amortization is typically the same on all deals, 25, 30 years, like your home mortgage. Commercial real estate, the loan terms are a lot shorter. You can't get away from this. Anywhere from 1 to a 15-year term is normal. So anything less than 5-year term might be a bit of a head scratcher, and that may not be for you as an investor. So we've seen this. And if you bought a property in 2021 at the peak of the market and the market corrected 30%, which it did, which is why it's such a great time to buy new assets at this point. But if you're in those 2021 vintage deals, you're screwed because now your $100 million asset is only worth 70 and your loan is due, right? You don't have enough runway to time you to get out of that trough in the market. So that's why we put the designation there, 5 years or less. If you had 5 years or more, you could probably value add the asset, get out of it, and or the market corrects back up to get you back to par level. But anything less than 5 years is something to be aware of. So this creates this huge buying opportunity right now. And look at the past market cycles. This is interest rates here. Again, every 7 to 9 years. This one says 7 to 10 because the last cycle was very long. But this happens again and again. And you never know when it's going to be. The next 2 years, probably thinking if you take a look at these last interest rate cycles, you got Volckers kind of mess up here. But typically, once the interest rates go down, it's a clear buying signal for the next several years. And that's when you make the money. And you need to be established now in a deal now and not get in the water once this wave starts to move. This is the way to read these market undulations and market cycles. Just speaking for myself, I never know when the next gray line is going to be happening. To think you can is silly. What you have to do is just diversify your holdings over 4 to 7 years as an investor, especially a passive investor. If you were in a deal established before 2020, you're totally fine. You may not want to sell now, but you're going to be totally fine. And I think that's where some investors who jumped in only in 2021, 2022 just got rocked. But plenty of investors on the opposite end that invested heavily and just didn't ran out of money after 2021. And boy, are they counting their lucky stars. And I look at this and I initially thought, man, this is really unfair. And you got a lot of smart investors that came in 2021, 22 and got decimated. And you got a lot of guys, they're not really good investors and they just happen to be jumping in at the right time. And how do you prevent a damage on your personal side? We diversify over 4 to 7 years. Now, for people who only jumped in 2021, 22 in less than 5 or 10 deals, which is not a diversified portfolio. I think a diversified portfolio is a dozen, couple dozen holdings plus. This may feel insensitive, but that's just how it is. The world is not fair, but that's what investing is essentially. You got to diversify over assets and especially time. Here's another image somebody shared with me. This is showing what the cap rates are. Again, you want to invest in the times where the cap rates take this drop. And this is when the pros get in at this point. And this is when typically the amateur unsophisticated investors feel queasy and they just sit things out. And then what's likely to happen, if you're a listener out there, don't be the guy who gets in the game finally after you see all signs are green in 2026, 27, because it'll be probably too late. And then you'll probably be the proverbial guy when you get in. That's when I'd like to pull back. But me, again, I take the approach of I just always dollar cost average. I never know when there's going to be a market shift. I always want to have exposure on the good side and the bad side too. I take it all. The average cap rates are and the 10-year treasury. And I've said this before, especially in the e-course, but investors invest off of the spread in the interest rates and what the cap rates are, what the properties are performing at that time. And you apply some leverage and that's how you make good returns. And then you force appreciate the asset to get the majority of returns that way. That's the simple formula. So you never can time the market, but if you could, right now would probably be that ideal time because as you can see, the squeeze on this is at lows right now. I don't think you saw these types of lows for some time, but it's when the gap is really big, like in 2020. We all know this in hindsight now, right? You can't steer that way. The spread is all-time lows, about 90 basis points. And the principle here is expect the spread to widen eventually. And here's the big player that I've been waiting for. Blackstone, they just bought up a housing investment with $10 billion. think they also bought like a $2 billion smoothie thing. They're buying up everything, essentially. They're jumping into the market. And for about a year now, a lot of us have been talking about when are the big players, the private equity guys, going to be jumping in and buying up everything. And now's the time. I will point out that Blackstone's kind of like a faceless organization out there. And they're the very ones that in very early on in the cycle in 2022, they created a historically big REIT, and they essentially went bankrupt on it, and all the investors lost money, and then they started to make these funds. So that's just the nature of investment, or especially with these guys. But the largest multifamily deal for Blackstone to date, $40 million for property improvements, and that's just mere 4% of the 10 billion. So a little bit money for value add. What I tell people is don't listen to people on stupid YouTubes or podcasts that are economists or making predictions. Follow people who are actually putting their money where their mouth is and quietly buying things. So this portfolio consisted of 76 properties, 27,000 units, and they expect closure in Q3. So it takes a quarter or two for them to close these things, which is exactly why that's just transactions today. We have some refinances that we're doing, and we have things we've sold off a couple of things this past year. And financing is so difficult right now for the buyers. It's taking 3 or 4 times the amount of time. So I totally understand why Blackstone is taking so long for them to push through this transaction. Wouldn't it be nice if somebody were able to tokenize real estate and have it just complete like that? Just saying. But this is why I'm saying, like, all right, you're gonna be that guy who is like the negative Nancy and say, I want to only invest when there's a clear signal that the interest rates are going to start to coming down. That's going to be too late. Number one, because I'm a seller in the market. I know once that starts to happen, I'm gonna jack my price up. The tables have turned. You are no longer the belle at the ball at that point. And number two, it takes so long to close transactions that you cannot get out in front of it. You're going to be on the backside of this thing. And what I guess my attitude is, I'm just going at this point, from historical evaluations, 30% off the highs, to me, it's good enough for me. If I can just buy it with long-term debt so that I hedge my downside, I'm just going to be picking things up. To me, at this point, it's a reboot. It's going around the monopoly board. You don't own anything yet, and you're just picking things up around the monopoly board at this point because everything is on a discount. And Blackstone's going to probably load up on more. This number has probably been updated again, but they said that 66 billion investment capital already. And Blackstone CEO says we're planting the seeds of future value at what we believe is a favorable time for deployment. And going back to the fundamentals, we all know that there's an increasing income and housing gap between the wealthy and everybody else. That gap right now, especially with interest rates and mortgage payments high, is all-time highs right now. There's a lot of supply running through the pipeline right now. Once those projects are built, we know that not a lot of projects are being originated. This is why we as developers are trying to get out of the gates now so that in 2025, 26, we can be out there opening up shop when there's less competition. But for the greater market, we do know that supply is going to go down, and this is going to exacerbate the already difficult situation for housing affordability out there. A different take on this, John Burns is another researcher out there. I put him in the category of economists. They said that we don't really need to build cheaper homes. We just need to solve the affordability homes. They created this little visual, but it just depicts the whole need for lower middle class housing out there. And I think it's just the right thing to do. If you can align your investing along with that positive narrative, then why not? The Wall Street Journal came up with this article, The Fortune Favors Early Movers in America's Property Crunch. Investors willing to buy buildings when everybody else is running scared typically get the biggest returns. Which side of the coin are you going to be following on? CNBC News says family office are looking beyond the stock market for higher returns. Family office have 46% of their total portfolio in alternative investments. And what are alternative investments? They include private equity, real estate, venture capital, hedge funds, private credit. So essentially buying up real estate or getting into real estate projects or buying businesses, not your standard American investment. Here's that trends cyclical report from ITR. Now, as you can see, like I said, financial and the housing has gone through the trough and it's coming up now. This is that buying signal. If not, just take Blackstone as the buying signal. But you have all these other lagging factors. Remember, when the Fed increases interest rates, and now I know this because it's written in blood for me that when the Fed increases interest rates very heavily, it impacts the financial sector and the housing sector very greatly. And this is why the financial and housing sector went through the pain and agony first, and now it's coming out of it. I'm in a lot of masterminds and other CEO boards, and right now, there's still uncertainty on their side. Do they need to cut back stack? A lot of them have decreased spending already. The smart ones have. We don't know if there's going to be a soft landing or a hard landing. Some people have already written it off that's going to be a soft landing. But what's going to happen is what ITR says, a lot of the other sectors haven't gone down one of these roller coasters yet. And to me, what this represents is your standard American investment. To me, I think it makes sense to take money from your standard American investments and put it into something that has already gotten through this trough, or at least re-diversify between the two. Again, the way I did this from 9 to a decade later, I had 100% of my net worth in real estate, or probably in this housing section right here. Now, I don't advocate that for everybody, but if you're under a couple $1 million net worth, you've got to have at least 30 to 50% of alternative investments in this sector. Look, even wealthy people who can just sit on their butts, do T-bills all day long, have 46% of this stuff in their portfolio. Now, take a self-reflection of where you're at. If you only have 2 deals at $200,000 and your net worth is $1.5 million, you're only at 15% right there. And your exposure to this is very lopsided, I think, for your net worth range. And your exposure to this is not enough. Of course, I'm not giving any financial advice here. I'm just sharing what worked for me and what I see a lot of other people doing out there. But this is depicted in my new book, In the Wealth Elevator, actually in a table and chart where I break down based on where you're at, what are some general things I've seen out there in terms of these percentages. And especially if you're under $1.5 million net worth, you got to get after it. You're not going to move anywhere in the standard American flair. You got to get into alternatives. Also for the tax benefits too. And that kind of brings me to the new book released. For those of you guys who are looking to absorb a lot of this really quickly, it's a pretty beefy book, 200 pages plus. I think the audiobook is 5 to 6 hours. I read it. And I added a bunch of other little tidbits, try to keep it more fun and lively. Added some stories. But the offer for those of you guys in our club right now, if you guys write a good review, send a screenshot to us, team@thewealthelevator.com, and we'll send you a free PDF copy and the audio version for you to share with your friends and family. We also have some other offers for you guys. If you guys buy, I believe, more than 5 copies, we'll send you a prize there. And if you also refer somebody to our club and they go through the onboarding process, we'll get you a prize on that one as a thank you. I do that because I really enjoy working with people who've already been doing this and understand this type of world already. Before we go into question and answer here, I took this picture before last summer, 2023. Back then, it was difficult. You got to realize that life has its ups and downs. I went through probably one of the lowest points, and the market corrected 30% over the last couple of years. Obviously, this impacted my personal finances. Despite this, I still believe in real estate. I still believe in investing. You underwrite the properties as well as you can. You're never going to be able to account for black swan events or interest rates to skyrocket the quickest time in history to 40-year highs, but you underwrite it conservatively and you dollar cost average. I think that's confirmed that for me so heavily. Dollar cost averaging and diversifying over multiple properties in multiple years. And I think no better time to build this than right now. But they got emotionally dark for a while. I was lucky enough to be surrounded by other general partners and people going through this. I still think that we flushed a lot of the problems in the portfolio through. I would say be careful out there. I see a lot of these other operators, they're doing these so-called debt funds or rescue funds. I know how they underwrite their deals. If the cap rates don't come under 5.25 for some of these guys, because I know they underwrite for a reversion cap rate of 5.25, everybody, including in the debt fund, is going to lose their money. There's a few people out there that I know that this is for a fact. We have the data. We have Yardi and CoStar, so we know what their properties are performing at. So there's no BSing that. There will be likely some pain there. And I know some of you investors out there that are in those deals out there. What I would say is really take a look at what the property is worth today. And when you're putting in money, are you putting your money on higher than where the bank loan is or well below that? So if the project gets taken back from the bank, there's no equity there for you in terms of that capital, extra capital call money putting in. In that case, unfortunately, it's just better to let the property go. And this is why in most cases, because the market has gone down so much, it's better in most cases to just wait for the property, buy it new. I'd be saying something different if the market only corrected 15, 20%, but it's well beyond that, folks. And this is why just going after fresh new deals is the smarter play on this. And be careful of these debt rescue funds out there. But in my darkest time, I took this screenshot, but this is Chinese characters. I can't read this. I can't read Chinese Mandarin. But if you look at the characters, there's a very similarity between danger and crisis when you jam up these characters and opportunity. And this is where if you're able to see how things really are and get comfortable with being uncomfortable, this is the Eastern philosophy of exactly what Warren Buffett is saying. When there's fears in the streets, that is the opportunity. When you go through danger and crisis, which what we've seen these last couple of years, there is opportunity in that. I started a new podcast, kind of new project focusing on mindset, emotional well-being, productivity, and relationships with your spouse too, in a new spin-off podcast. I call it the Rich Life Podcast. So if you guys are interested in that topic material, it's a little bit different than the flagship Wealth Elevator podcast, but you can check out that podcast on the YouTube channel under the podcast section that we have. And then if you want, you can check it out on iTunes. If you guys need the links, just send our team an email. We can send you that to you. Money is one thing, but more and more I'm realizing that the emotional side, just like the peace of mind, the mindset is a big part of that. My whole thing, like there's a lot of folks out there that I was like this at one point in my life where everything was about money. Right? I need to save money so I can get retirement, so I can build my net worth. And I think that's great, right? That's growth in an area. But I myself reflected on kind of my journey these last 10 years, and maybe there should have been more attunement to social relationships, having a community, mindset, personal development. And that's what I guess that's been my formula is start to build a community about it, start to talk about it. And that's what this new Rich Life podcast is all about. The last 2 years have not been very good out there with the interest rates being increased, really unsettling times. But I think the more and more that's in the opportunity itself in that arena, right? Like until difficult times come around, you don't really have the motivation to do things. And at least that's what I've seen from talking to so many people, you guys who book these calls with us, that the reason why you jump on that onboarding call with me is there's usually some kind of deep rooted issue or something that happened, whether that's you getting passed up for a promotion, or you had some kind of health scare, or you got a divorce, or you actually mapped out your finances and put it on a spreadsheet and realized this is not enough. I need to do something different. And that's the aha moment for some people to start to get educated. I think that's where you find us. You read the book. You consume the content that we had. That's what pushes a grown man, grown woman to spend 8 hours and going to the syndication e-course, right? Who does that? You guys do. And there was something that probably motivated you to do that, as it did when I first started. I didn't like my job. I was like, man, I can't handle this. But what I would say and be careful of, and I'm guilty of this too, is as humans, we're very resilient and we get used to things very quickly. I would say in 2 or 3 months, we get used to the status quo. So as at one time, you are really gung ho motivated about learning about alternative investments, getting your infinite banking all set up, and then now getting these passive losses, maybe implementing rep status and cutting your tax bill by at least a quarter. And you're like, this is a lot of content. I'm confused. I don't know anybody around me. And that's why we have the Family Office Ohana Mastermind. If you're out there on an island trying to absorb this stuff, you're on an uphill battle, right? You need community around you. You need other think tank around you. And it also makes it a lot more fun. Not many people these days meet new friends or financial friends above the age of 30 or 40. At least that's speaking for myself. That's speaking for what I see from my older generation around me. It just becomes really stagnant with old friends from college. Social relationships are the currency that are the rich. But I digress there. So getting back to it, if you don't ride that wave of motivation now and get plugged into a community or start investing, you're likely to just accept the status quo that I'm just going to have to invest in my 401k stuff, pay a lot of taxes, never have a privatized bank, infinite banking, accredited investor banking, and I'll just be like everybody else. Because why not? Everybody is doing all right. It's like the Lego movie. Everything's fine. And if you've come to accept that, then I think that's good for you. But if you truly think that there's something better out there and you can go for it, then I think you need to move and take action and surround yourself with the right people doing this type of stuff. But yeah, I think things are definitely moving in the right direction here in terms of the market. And I would also want to throw out one more last resource. A lot of these articles and new articles that I find, I will put at on our news page at thewealthelevator.com/news for you guys to pull this stuff yourself. All right. Thanks everybody for joining. Bye.